This episode's featured book is called Investing the Templeton Way. John Templeton is revered as a master in the global investment arena, and Forbes magazine has named him one of the most successful fund managers in history. How successful? If you had invested $10,000 with him in 1940, by 50 years later that money would have become $55 million. Before we get started, please click on the subscribe button below to stay updated and support Daily Book Dive. How did Templeton achieve this? Throughout his 70-year investment career, he consistently implemented a particular investment strategy, famously known as the Contrarian investment method. What is contrarian investing? Here's a simple example. After the 9/11 attacks, there was global panic, and the U.S. stock market was temporarily closed. When it reopened on September 17th, the market plummeted as many sold off their shares indiscriminately. At this moment, Templeton began buying stocks in the plummeting aviation industry, betting that the government would not let this sector collapse. 6 months later, the companies he invested in had yielded returns up to 72%. As you see, going against the grain during periods of extreme pessimism is the essence of contrarian investing. The core philosophy of contrarian investing includes a concept Templeton described vividly: wait until the 99th of 100 people have given up. This is the heart of contrarian investment. The book's authors are John Templeton's grandniece and her husband, who had intimate access to his life and work. They thoroughly narrate many classic cases where Templeton successfully applied his contrarian strategies. Through these stories, you can understand the foundational logic of contrarian investing, how to identify the point of extreme public pessimism, and how to have the courage to buy when everyone else is selling. This book is not only a biography of John Templeton, but also a vivid textbook on contrarian investing. The remainder of this episode will detail Templeton's method for achieving stellar investment returns, divided into 3 key terms: the bargain stock hunter, global investing, and bravely short selling. First key term: the bargain stock hunter. Let's start with the most frequently mentioned term in the book, bargain stock, which does not simply refer to the absolute price of stocks, but to those whose market price is far below their intrinsic value. Templeton's long-term investment success largely came from seizing numerous bargain stock opportunities, earning him the nickname bargain stock hunter. How did this investment style form? The book mentions his childhood experiences as a major influence. In the 1920s, when John Templeton was under 10 years old, his father, Harvey, a lawyer, had his office on the 2nd floor next to the town square in Winchester, where auctions were often held. Whenever no bids were made at an auction, Harvey would quickly go downstairs and place a bid, usually acquiring farms at very low prices. By the mid-1920s, he owned 6 properties. Why were there times when no one bid at these auctions? It wasn't that the locals lacked insight, but rather that foreclosure auctions often resulted in no bids, due to reasons like information asymmetry between buyers and sellers, and the emotional states of participants. During economic downturns, market pessimism could lead to no bids, presenting prepared individuals with opportunities to pick up bargains. This childhood impression profoundly influenced Templeton throughout his life. As an adult, he continued this bargain hunting mindset. For instance, shortly after moving to New York with his wife, they furnished their 5-room apartment for just $25, a sum equivalent to about 2,000 renminbi today. Templeton not only applied this thinking to his everyday life, but also to his stock purchases. In 1939, as the American economy began recovering from the Great Depression, Templeton saw it as a great investment opportunity. However, he didn't have much money, so he borrowed from his former boss to buy all the stocks traded in the U.S. market priced below $1, a very low threshold. Templeton believed that the stocks of the least efficient companies would experience the most dramatic increases. His boss supported this idea, and Templeton invested $10,000, eventually buying 104 different stocks. His prediction was correct. Within a year, he had repaid his loans. Over the next few years, he gradually sold these stocks, turning his initial $10,000 investment into $40,000, a 300% increase. At the end, only 4 of the 104 stocks he had purchased were unsuccessful. This successful venture marked a beautiful start to Templeton's long investment career. It seems simple, but the method behind it was not trivial. Missing the nuances could lead to significant mistakes. Let's look at some key points. The first key point is judging the big trends. In 1939, the U.S. economy had been recovering from the Great Depression for some time, and Roosevelt's New Deal policies were being implemented. Despite still being a difficult period, the economic recovery was unstoppable. The second key point still revolves around low price. As mentioned, the book defines low-price stocks not just by their absolute prices but significantly by their undervalued prices relative to their value. Why, in this case, did Templeton not use complex methods to calculate the value of companies, but instead used a very simple indicator: stock prices under $1? As mentioned earlier, having just experienced the Great Depression, people were in a deeply pessimistic mood for a long time, and the depressed stock prices fully reflected this pessimism. At this time, selecting the lowest price stocks could potentially yield the greatest price elasticity during the economic recovery and resurgence of confidence. Let's look at a specific example. Among the stocks Templeton purchased, one, because of its astounding return, became a classic case. This stock was the Missouri Pacific Railroad Company. When Templeton bought into it in 1939, the company was nearing bankruptcy and its stock price had fallen to $0.125 per share. A few years later, the price rose to $5 per share, an increase of 39 times. At that time, many American railway companies were listed, such as another company with much better operating conditions than the Missouri Pacific Railroad Company, which had never lost money in 50 years. However, if Templeton had bought this company's stocks at that time, the increase in stock price would have been much smaller. Let's do a more detailed statistic, finding 2 groups of companies in the U.S. market at that time. Group A consists of companies that often lost money before 1940, referred to as the bad companies. Group B consists of companies that had never lost money before 1940, referred to as the good companies. We can find that, 5 years later, the average return rate of stock prices for Group A was 1,085%, while for Group B, it was only 11%, nearly a 100-fold difference. Of course, since the book's statistics are not comprehensive, this 100-fold difference conclusion may not be entirely scientifically rigorous. But this statistic does illustrate an important principle. At extremely pessimistic times, investing in currently poorly performing bad companies can yield much higher returns than investing in good companies. This is because bad companies are more likely to be influenced by public pessimism, making them incredibly undervalued. The third key point about Templeton's operation is the holding period. After buying stocks, he didn't just hold them for a few months. His average holding period was 4 years, allowing sufficient time for stock prices to recover. Notably, 4 years was also the average holding period for stocks throughout Templeton's entire investment career. This clearly shows that contrarian investment methods require a longer time to be effective and are not suitable for short-term operations. The fourth key point is sufficient diversification. Although the principal was $10,000, Templeton bought 104 different stocks, spending less than $100 on each. This level of investment diversification seems inconsistent with the value investment principle of concentrated holdings. Why is this? I'll explain the difference between Templeton's diversified investment and Buffett's concentrated holdings in detail later, but here's a hint. When buying these stocks, Templeton only looked at one indicator, that the stock price was under $1, meaning he didn't conduct in-depth research on the fundamentals of the companies he was buying. Therefore, diversifying risk in this investment was extremely important. You can't put all your eggs in one basket. In fact, years later, 37 of the 104 companies went bankrupt. However, By that time, Templeton had already sold the stocks, so it didn't affect him. This brings us to the end of today's first key term, the bargain stock hunter. We can see that Templeton's investment philosophy of buying bargains, from his childhood to his everyday life, and even in the financial markets, consistently implemented this way of thinking. Second key term, global investing. In November 1954, Templeton launched the Templeton Growth Fund, pioneering global investing. American Forbes magazine called him the father of global investing. Today, global investing seems very normal, but back then, it was a groundbreaking thing. At that time, people generally believed that the United States was the most important country and the U.S. stock market was the best investment market. So there was no need to buy stocks in other countries. Templeton's bold step towards global investing in a conservative environment at that time was greatly influenced by his mother from a young age. In that era, Templeton's mother was a rare woman with a spirit of adventure and pioneering. When Templeton was 12 years old, his mother took him and a brother from the northeastern United States on an adventurous trip, camping along the way, cooking their own meals, and visiting desired sites and museums. This adventure deeply impacted Templeton. From a young age, he believed that culture and geography are boundless. For Templeton, besides being deeply influenced by his mother's adventurous and pioneering spirit, global investment was a perfect match for his bargain stock hunting method. First, global investing greatly expands the pool of bargain stocks. If you only choose bargain stocks within the United States, you have only 3,000 stocks to choose from. But if you expand your range globally, you might have at least 20,000 stocks to choose from. Second, at the same time, different countries might have completely different prospects and public sentiments, even showing some kind of alternating cycle pattern. If you want to take advantage of the opportunities brought by pessimism and negative sentiment, comparing and switching between different countries can bring more and better investment opportunities. Third, the method of bargain stock investing means that after buying, you might still need to go through a phase where the stock price continues to fall. At this time, sufficiently diversified investment is very important for risk control. Investing globally can obviously be more diversified. Let's look at a practical case to see how Templeton made a lot of money in the Japanese stock market. After World War II, Japan became a defeated nation, and its economy hit a low point before gradually recovering. However, until the 1950s, Japan was still seen as a low-income manufacturer of cheap goods and was not taken seriously worldwide. However, just when the public had not yet noticed Japan, Templeton had already begun paying attention to the Japanese stock market. Early in the 1950s, Templeton found an English-speaking broker in Japan and invested his personal savings in the Japanese stock market. Entering the 1960s, Japan's economic development hit the fast track. In the early 1960s, Japan's average economic growth rate was 10%, while the United States was about 4%. But from the perspective of stock market valuations, the average price-to-earnings ratio of the Japanese stock market was about 4 times, while the U.S. stock market's average was about 19.5 times. The lower the price-to-earnings ratio, the cheaper the stock valuation, which means the stock price is cheaper. In other words, Japan's economic growth rate was 2.5 times that of the United States at that time, but many Japanese stocks were valued 80% lower than the average U.S. stocks. The reason the stock prices were so cheap was because of the global bias at the time. Japan was a defeated nation, only capable of producing cheap small goods, and could never catch up to the United States. Under the influence of this mainstream bias, a lot of bargain stocks appeared in Japan, which was precisely the investment opportunity Templeton had been dreaming of. In the early 1960s, Japan lifted restrictions on foreign investors' capital inflows and outflows, and Templeton immediately invested his managed fund in the Japanese stock market. In the 30 years following Templeton's first investment in Japan, the Japanese stock market index experienced an astonishing increase, with the Tokyo Stock Exchange's Topix index increasing 36 times. Thus, Templeton's fund made a lot of money in the Japanese stock market. In the late 1980s, as the Japanese stock market entered its final frenzy, Templeton withdrew most of his investments in Japan. This was because, with the influx of a large amount of international capital, the valuation of the Japanese stock market had become very high, and by comparing with other countries, Templeton found better bargain stocks in Canada, Australia, and the United States. This also reflects an important method in selling stocks. When should you sell stocks? Templeton's answer was, when you find a better stock that can replace it. This fully demonstrates the benefits of global investing. If you were only investing in the US stock market at the same time, your return would have been much lower. Let's look at a specific number. If you had invested $10,000 when the Templeton Growth Fund was established in 1954, by 1992, that $10,000 would have turned into over $2 million. The investment method of this fund was a combination of bargain stock strategy and global investing. If you had only invested in the US market during the same period, according to the S&P 500 index's increase, your $10,000 would have only turned into $100,000. As you can see, the combination of bargain stock strategy and global investing is a very powerful investment method. In fact, in addition to investments in Japan, Templeton used the bargain stock strategy in South Korea, Mexico, and even China, among many other countries, seizing a large number of investment opportunities and creating astonishing investment returns. That's all for today's second key term, global investing. Third key term, bravely short selling. Let me first explain what short selling is with a simple example. Suppose there is a stock A in the market, priced at $100. After researching this company, you think this price is clearly overvalued, and that the fair price for this stock should be $30. Then you can borrow 10,000 shares of stock A from someone who already owns it. This borrowing process doesn't require you to find the person yourself. It is generally completed through a brokerage firm, and you pay a certain fee. After borrowing the stock, you sell these 10,000 shares of Company A at $100 each in the market, receiving $1 million. If, after 6 months, the stock price actually falls to $30, you then buy 10,000 shares at $30 each, spending $300,000. You return these 10,000 shares to the person who originally lent them to you, and the short selling transaction is completed. Did you notice? Before, you sold the stocks and received $1 million, but later, you bought the stocks and spent $300,000, and the difference of $700,000, minus some fees, is your profit from short selling. The key to short selling is your judgment that the stock price will fall, and the more it falls, the greater the profit. Let's look at how Templeton skillfully used short selling to make money. Let's rewind to the end of 1999, when Nasdaq's internet stocks were at their peak, and everyone was crazy about internet concept stocks. How crazy? At that time, a startup entrepreneur would receive such advice. Add an E in front of the company name, and the company's valuation could skyrocket. A group of traditional value investors, such as Buffett, were mocked by the market for not buying tech stocks. In December 1999, the cover of Barron's Weekly, America's most famous financial magazine at the time, featured a large photo of Warren Buffett with the headline, "What's wrong, Warren?" Clearly, this was mocking Buffett for being too conservative and falling behind in the new era. By December 1999, the average price-to-earnings ratio of Nasdaq had risen to an incredible 151.7 times, like a runaway train that couldn't stop. And just when the market was at its craziest, Templeton was ready to make his move, this time preparing to short a batch of tech stocks. It's important to note that it's very difficult to predict the level of public euphoria, and shorting tech stocks that had risen so dramatically carried a great risk. So how did Templeton do it? He found a very good entry point. According to the rules of the Nasdaq at the time, after an IPO, company executives had a 6-month lockup period during which they couldn't sell their own shares. But once the 6 months were up, they could sell. Templeton analyzed the market at the time and concluded that a large batch of tech stocks was severely overvalued. So once the 6-month lockup period ended, many executives would sell their shares, which could trigger a chain reaction leading to further declines in stock prices. Therefore, he devised a well-thought-out short-selling plan. First, Templeton selected a batch of tech companies whose stock prices had risen more than 3 times their IPO prices. Then, 11 days before the end of the lockup period, he began short-selling the stocks, waiting for the potential stock price decline triggered by the executive sell-off. He found 84 such companies, shorting $2.2 million worth of stocks for each company, totaling a bet of $185 million. Shortly after he began short-selling, on the second Tuesday of March 2000, just after the Nasdaq index had just hit a new high of 5,132 points, tech stocks began to plummet, and this was just the beginning of the subsequent drastic decline. Within less than a year, the Nasdaq index was cut in half, and many of the stocks Templeton shorted fell more than 95% in price. Yes, you heard right, they fell 95%. These companies, which were once chased by everyone, fell to worthlessness within a few months. Undoubtedly, this was another classic battle of contrarian investing. Of course, it must be emphasized again that short selling is a very risky operation. Therefore, Templeton had set strict risk control rules for this operation in advance. He first set a threshold. If the stocks he shorted not only didn't fall but instead soared in price, once they exceeded this threshold, he would quickly end the transaction by buying back the stocks. Additionally, in a profitable state from short selling, he set 2 conditions, and if either was met, he would also end the short selling transaction. The first condition was that if, after he shorted the stocks, their prices plummeted by 95%, he would buy back the stocks and end the transaction. This is what we usually call taking profits, or stopping while ahead. The profits from this transaction were sufficient, and it was time to end. The second condition was based on the earnings per share over a year. If the price-to-earnings ratio of the stock he shorted fell below 30 times, he would also end the short selling. This was because the original reason for short selling was that the stock value was severely overestimated. If the price-to-earnings ratio dropped below 30 times, it meant that the reason for short selling no longer stood, so the transaction needed to end. This is today's third key term, bravely short selling. Short selling stocks is generally considered a high-risk operation in the market, and many value investors do not engage in short selling. But actually, this method also contains a lot of investment opportunities. Templeton, having made adequate risk controls, demonstrated what is called a beautiful short sale. That concludes this book. Let's summarize the content of this episode. We discussed 3 key terms. The first key term is the bargain stock hunter. The key to Templeton's contrarian investment method lies in low prices, and he generally uses 2 quantifiable standards to measure whether stock prices are low enough. The first standard is that the price should ideally be 80% below the value, meaning you can buy something worth $10 for $2. Such bargains are not easy to find, but the greatly fluctuating emotional financial markets provide plenty of opportunities for this investment method. The second standard is that the price-to-earnings ratio 5 years later should not exceed 5 times. That is, dividing the current stock price by your predicted earnings per share 5 years later, this number should be below 5. We all know that predicting 5 years ahead is very difficult, almost impossible to do accurately, but this is also a very good way of thinking, forcing you to focus on the long-term operations of a company, automatically filtering out much of the short-term noise. The second key term is global investing. If we liken the investment method of the bargain stock hunter to fishing for a particular type of fish, the more ponds you have, the greater your chances of catching this special fish. This is the theoretical basis of global investing. In the 1950s, Templeton was the first to expand the investment scope from the U.S. mainland to the global stage. Using the concept of searching for bargain stocks, he made substantial gains in Japan, South Korea, Mexico, China, and other countries, contributing greatly to his brilliant investment performance throughout his life. The third key term is bravely short selling. Templeton was a person full of adventure and pioneering spirit, with an extremely broad vision. Thus, he was also able to use the generally less utilized method of short selling to make money. For example, from the end of 1999 to 2000, during the craziest period of the Nasdaq internet bubble, he skillfully shorted and bet on the subsequent crash of internet stocks, earning a lot of money. Finally, let's share a bit about where Templeton's contrarian investment method stands in the investment field. Templeton is a grandmaster in the field of contrarian investment, and his contrarian investment method broadly belongs to a type of value investment method. However, this method has a clear difference from the familiar Buffett-style value investing. The core of the value investment philosophy can be summarized in one sentence: buy company stocks at prices significantly lower than their intrinsic value. To achieve this, three very valuable abilities are needed. First, valuing the company at the present. Second, assessing the company's future competitiveness. Third, waiting for and seizing opportunities when stock prices are significantly lower than their actual value. The familiar Buffett-style value investment focuses on the second ability, accurately assessing a company's future competitiveness. You need to select companies that match your judgment from thousands of companies. Then wait for the right price and hold a significant position. For example, Buffett chose Coca-Cola and See's Candies. The characteristic of this method is that the number of stocks held is not large, usually just a few dozen, so it particularly requires in-depth company research to dare to hold a significant position. Templeton-style contrarian investing focuses on the third ability, seizing the point of extreme public pessimism. When public sentiment is extremely pessimistic, that's the time to pick up gold in the market. The characteristic of this method is that a relatively large number of stocks need to be held, generally dozens or even hundreds, so it particularly requires a breadth of research. For example, if you only look for extreme pessimism in the US market, you might only find one opportunity every 10 years. But if you look globally, there might be a good opportunity every 3 years. Simply put, Buffett-style value investing focuses more on researching a company's fundamentals, aiming to select great companies. Templeton-style contrarian investing focuses more on grasping the point of extreme public pessimism, aiming to find the best opportunities to buy bargains. These are the fundamental differences between the two investment methods. One of the authors of this book is John Templeton's grandniece, so she had access to a lot of first-hand material, vividly showing us the essence of Templeton's contrarian investing. However, the book has a small regret. It only discusses Templeton's successful cases. We know that no matter how excellent an investor is, during their long investment career, there must also be many failures, such as in the 1970s when the funds managed by Templeton had periods of underperformance. However, Templeton's experiences of failure and how he learned from mistakes were not covered in the book. If you want to learn about contrarian investing, please also remind yourself. Contrarian investing is a long-term effective investment method, but in the short term, you may have to endure the torment of price movements in the opposite direction. So be fully prepared psychologically. Lastly, let's recall a famous quote by Templeton. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on excitement. The most pessimistic moment is the best time to buy, and the most optimistic moment is the best time to sell. The original book link is attached at the end for further reading. You can also click the share button below the video to share this book with your friends. Congratulations, you've just finished another book.